Hey investors, welcome back to another episode of View. In today's episode, we'll be valuing 10 stocks from Nifty 100 space. Some of these stocks are already owned by me in my portfolio, and some of these stocks might be owned by you. We'll be ranking these stocks in 5 tier. We'll be discussing does it make sense to bulk buy these companies, hold them, or sell them for good. So without wasting much time, let's start this episode. The first stock on our list is HDFC Bank. It's India's one of the biggest private sector bank. Now, I invested in this particular stock in 2023, and right now I'm sitting on a profit of almost 28%. Now, HDFC Bank is a 15 lakh crore company trading at a PE of almost 21 right now. It enjoys a healthy ROE of 18, and this has been dropping now after the merger of HDFC Bank with HDFC. And since then, they have seen some amount of problem in their profit growth and their sales growth. Their sales growth expanded because it was merger of two different entities. If we see what's the trend in P, this company used to trade at a historical high PE of around 25, 26, and right now it is trading at a relatively lower P. The P rating happened, and it is currently trading at a PE of 21, and it's going towards higher valuation. Now, in my opinion, this company is already trading at a valuation that is close to its peak, which is at least if we see like 3 year average, then it's trading at least at its highest position in terms of P with respect to 3 years. Now the question is, can P expand from this position? Because right now the sales growth that the company is expecting will be around in line to the GDP growth of the company multiplied by or like with addition of inflation. So all in all, we can expect around 18 to 20% growth in the sales. Not sure how they're going to improve their profit. It will highly depend on their operational efficiency. So what are we going to do with this particular stock? Now, right now, I'm holding almost 100 share. Now, I built these positions during November 2023 when the stock was in its correction phase. I don't think it was in correction phase. It was trading at its local maximum at that time. And that's why my returns are also not significant. It's only 30%. But based on the current valuation, I think I would like to trim some position, book some profit, and rotate this capital at some place else. Now, if we take a look at the technical analysis of this stock, then right now the stock is trading above its 50 DMA. That means the stock is in a bullish trend right now. And the company has been giving a healthy dividend since the past. That means it's a low risk company. So, what's the harm in riding the wave? Now, LDFC Bank is trading at a PE of 21. It's fairly valued with respect to the entire market in Nifty 50. Along with that, it's trading at a level which is above its 50-day moving average and it's in a bullish trend. On the basis of all these factors, I think I would like to ride the wave. I would not start cutting position because I don't see any consolidation happening at these prices. So, my verdict is just to wait and ride the wave. Now, next company on our list is a conglomerate. It's called Adani Enterprises. It's owned by Gautam Adani. And this company operates in multiple sectors, from mining to construction of roads to managing of ports and building of infra. This company is planning a major capex in the coming years. So let's try to value this company. Now, Adani Enterprises is a 3 lakh crore company trading at a PE of almost 70. If we take a look at the recent stock performance in last 1 year, the stock is in a correction phase. And the stock has been in a correction phase since last 3 years when the entire Hindenburg saga began. The company is trading at a historical P, but again, this P is relatively higher compared to any other Nifty stocks. Now, if we take a look at the historical P, the company is still trading at a historical high valuation with respect to its previous PE trends. It used to trade at a PE of 21, 22, and right now it's trading at a PE of 70. But again, the growth justifies the valuation, and the company has been growing at a significantly higher rate. It is able to expand its profit. The sales is not expanding because this company main revenue will also include the dividends that's paid by its subsidiaries and the cash flow that they're generating from their subsidiaries, because all the companies like Adani Green, Adani Renewables, they are a subsidiary of Adani Enterprise. Now, when we look at cash flow statement, there are some problems that Nifty GPT highlighted. The company is planning a huge amount of capex, but they are under a straining cash flow. Now, they might be having a political connection, and that way they'll be able to get debt easily. I'm not sure about that, but this is an angle that I cannot ignore when I'm dealing with any Adani company. So, is it something to be worried about? According to Nifty GPT, yes. If you're risk averse, you should avoid that. But on the basis of valuation, I think the company is undervalued with respect to the capex that they're planning. But I'll never invest in this company because I want to make sure my investment are completely independent of political policies and political changes. So if the political angle did not matter to me, I would consider Adani in a can buy bucket based on the future growth that can happen in this particular company. But again, I am not planning to invest my capital over here, and I've never invested my capital in any of the Adani stock because I'm not sure what's the political connection that it has with the current government and how it will impact its future growth. So that's my take on Adani Enterprise. The next company on our list is really special. It has a mode that no other company in Nifty 50 or Nifty 100 space enjoys. This company is the biggest bottler of Pepsi outside America, and it's the biggest bottler in Southeast Asia. Varun Beverage has a license to manufacture and sell Pepsi product till 2039 in Asia and in Africa. They are having a huge amount of capex right now, and they are planning a strong expansion in Africa. So let's try to value this company. Now, Varun Beverage cannot just be defined a traditional bottling business. They also have certain brands that they own. One of the special brand that I think I was interested in was Sting. It was giving almost 30% volume growth year on year since last 2 or 3 years. That means the energy drink market, low cost energy drink market, was a segment that no one cared about, and they were able to capture a huge market of it. And then all the other players came into it. If we see the valuation of this company, it's trading at a market capitalization of 1,54,000 crore with a PE of 55, which is on the higher end with respect to Nifty 50. The company enjoys a healthy ROCE of 24% and ROE of 22%. If we take a look at the stock performance of the company in last 3, 4, 5 years, the company was in an expansion phase. They were buying bottling companies all around India in east, west, north, south, and they were just getting their business by just acquiring them. And the company saw an explosive growth. Since then, the company entered into a consolidation phase, and right now the stock is in a correction phase. Now the question is it a right time to buy? Now, if we see the historical valuation of the company right now is trading at its historical valuation. However, the company now enjoys a stronger foothold in the Indian market and demands a premium valuation. Now, the company has been looking for a major capex, almost 3,800 crore in past 1 year, and they are looking for expansion in international markets, specifically Africa and some of the nations in Asia. Now, according to Nifty GPT, this is a bulk buy, but I want to understand what's the technical indicators look like. Does it make sense to invest at this particular stage? So from a technical analysis point of view, the company is overvalued relative to its technical strength, and the company is trading in a descending channel with the bearish trend across time frames, and there is no sign of reversal yet. So bulk buying might not be the right strategy because I don't know how much this particular stock can correct. Now I'm sitting on a healthy profit in this particular stock. I invested long back, almost 3.5 years back in this company, and I'm sitting on a profit of almost 181 crore right now. Now I'm not sure if I want to liquidate the entire position, or I'm also not sure like if I want to bulk buy at this particular stage because the technical indicators clearly state that um, the price trend is going downwards and there is no sign of reversal. So I'm pretty sure the stock is not going to jump 10 or 20% in a single day even when the reversal happens. So I'm planning to hold before I make a big move in bulk buying. So since I'm already holding position and I understand the business, it's simple to understand. It maintains a healthy ROC and the company is able to maintain a healthy margin while growing its sales more than 15 to 18%. I think I want to keep Varun Beverage in a can buy bucket. I don't want to buy heavily right now because there is no sign of reversal in the technical indicators. As soon as the technical indicators change, I would probably consider having a bulk investment in this. Now, next company on our list also enjoys a moat. It's the biggest tobacco manufacturing company of India. Along with that, it's a conglomerate, but it's able to use the cash flow that they are generating from the cigarettes business and trying to grow other business like notebooks, hotels, and any other things. So let's try to value ITC. So ITC right now is a 5,16,000 crore company. Right now it's trading at a PE of 14 and it's having a dividend yield of almost 3.5% with an ROCE of 36 and ROE of 47. Now all these numbers does not look correct. Like how can such a great business be trading at such a low valuation? So here are key points about this company. The P ratio fell significantly in the last 1 quarter. It was trading at a P of 25, 26 with a growth of about 8 to 10%. The reason was the company divested and they sold some amount of their subsidiaries or some of their business vertical, because of which they were able to get 14,000 crore in profit or other income in just last 1 year. Now, ITC will maintain a healthy growth of about 10% for next 5 years, and they have shown this growth in the past few years as well. Apart from that, the company is a sin business. That's why they are always going to face headwinds from the government. However, there are some sector tailwinds as well. India's rural consumption recovery is happening. The government is trying to cut down taxes on the lower middle income so that they can have more cash. And a company like ITC will be sure to benefit from a move like that. The company has been focusing on a consistent capital allocation of about 2,500 to 3,000 crore per year. And they are prioritizing their FMCG expansion, Ashirwad Atta, noodles, Maggie, and all these things. Now, from a long-term point of view, ITC is a business that's able to generate a healthy amount of free cash flow, and they're able to reinvest their capital into their core business. That's why I think fundamentally ITC will always remain a strong company. The company might face some sectoral headwind or consistent headwinds from the government, but the tailwinds in the direction of the company are like really strong because the government is trying to cut down tax. So I would rank ITC as a can buy. I think the company has strong fundamental. It's not trading at a exaggerated valuation, and I think we can build some positions if we want to look for a 3 to 5 year horizon. Next company on our list is a company that's getting benefit from all the renewable energy story by the government. Now, government is planning a huge amount of investment to shift India from fossil fuels to renewable energy, and Adani Green is in the center stage for that. Let's take a look at the fundamentals and let's try to value this company. This company is a 1,60,000 crore company and it's trading at a PE of almost 97 right now. The company is observing a healthy sales growth of about 20 to 25%, and they are observing a profit growth of about 50 to 30%. They are in an expansion phase. The company took a huge amount of debt in the past, and right now it's still sitting on a huge amount of debt, but it also includes the land that they have leased in the past. So, from my point of view, like if we see the price history of the stock right now is trading at a 5 year long valuation. Like if you would have invested in this stock in 2020 and right now it's sitting at a same price. The interesting part is the shareholding pattern. Both DIIs and the promoters bought a major stake in last 2 3 quarters since the stock price saw a major correction. So what should we do? Now, from a capex point of view, I think Adani Green has a good story. They are planning to expand their total energy portfolio to 22,000 megawatt from 11,000 megawatt, which is expansion of their capacity by almost double in next 5 to 6 years. They're targeting a capacity of 50 gigawatt just from renewable energy by 2030, and they are thinking about having a capex of about $15 billion in the coming years. The company is going to achieve this 50 gigawatt target by having both combination of wind and solar energy. They are building the biggest solar wind power park in Khwada, Gujarat. I hope I pronounced it right. Now the question comes in, does it make sense to buy this company at this particular valuation, even though there is a political connection? I think it makes sense. The company is going to have a long-term story. It's supported by government and it's trading at a valuation that's equivalent to its 4 year old valuation. That does not mean the company is trading cheap, but the company is offering a growth with a price that I think is worth to pay. So I will keep Adani Renewables right now in once in ages opportunity because the company is trading at a valuation that's equivalent to its valuation 5 years ago. The next company is the flagship company of Tata Group. It's called TCS and it's one of the biggest consultancy service company in the world. They have multiple clients in Fortune 500 companies and they have a business model that makes sure that their client get end-to-end tech solutions. So let's try to value this company based on its past performance. So TCS is a 12 lakh crore company right now trading at a PE of 25 with a ROCE of 64. However, the stock right now is in a correction phase and the problem that investors are having is the entire AI stories. A lot of investors fear that the AI story is just going to take away the business. However, I have a different belief. I think this might be a time that TCS can use AI to improve its operational efficiency and improve their margins. The company right now is trading at a like PE of 26, and the company maintains a healthy margins consistently across the years. If we talk about other fundamental metrics, then the company right now is trading at its historical low market cap to sales ratio. That means this company was never cheaper in last 5 years except the COVID crash compared to this valuation right now. In the last 2 or 3 years, the company's sale has not been strong. Like the company was only able to deliver a 6% sales growth and 4% profit growth, and the company's stock price is observing the pressure. And if we see how the shareholding pattern is changing, the company's promoter are not diluting that starter group. They are still the majority stakeholder in the company. However, we have seen some amount of selling from both FII and DIIs are buying the stock at this current. TCS is a quality business that's offering steady growth with strong cash flow. And they are offering dividend as well at this stage, 1.75%. That means they are not able to look for growth in near term point of view. Otherwise, why would they pay dividend? So let's take a look at the cash flow statement and where are they planning their capex. Now I'm pretty sure as more companies are going to adopt AI, the Fortune 500 companies are going to come to TCS to integrate AI solutions with them, and that's where they are planning their entire capex. If we see the capex and the future growth for TCS, it's mainly going to come from digital transformation that's based out of AI and automation. The company is focusing on product-led solutions now rather than just consultancy services. Now, as they turn into SaaS business, their margins are going to improve slowly, and they'll be able to predict future cash flow without worrying about the deals. And this is really interesting because they're also looking for strategic partnership with multiple countries, and they are looking for global expansion in multiple countries. They had recent tie-up with Air New Zealand, JLR, and Nest, and this basically shows trust in this company for major companies around the world when it comes to technical consultancy solutions. Now, TCS is a company with a strong fundamental that maintains a healthy margin, and it's owned and maintained by a promoter that's world class, top class management team. So I think TCS right now it's trading at a once in ages valuation. The company enjoys a healthy margin, healthy ROCE, and I would not think twice in betting my money on TCS for a long term, 5 to 6 years at this valuation. The next company on our list is a food service platform. It's a new age tech company as well. It's called Zomato, and recently they renamed their brand to Eternal as they're focusing on a more diversified logistics business. So let's try to value this company because it's trading at a all-time high right now. And let's try to understand, does it make sense for us to invest in this company? Now, right now the company is trading at a valuation of 2.5 lakh crore and a PE of 479. At this stage, your mind should go nuts. Like, hey, this valuation is just too high. Why should I even invest in this company? The company does not have a healthy ROE, healthy ROC. However, the company is only focusing on expanding their sales and growth. And if you see the market cap to sales ratio, it's still trading at a historical low just after they IPO'd and the stock saw price correction. Now, this company is really interesting because they are able to grow their sales at more than 50%. Not a lot of Nifty 50 companies are able to do that. So they are unique from that point of view. You'll see the profit growth as 136% in the recent time. That's because the company was unprofitable when uh, they IPO'd, and right now they're like focusing on expanding their profit so that they can maintain a sustainable, healthy business because they need cash flow to reinvest in that business to grow. So that's why take this number with a pinch of salt because EPS is just turning around from negative -1 to 0.055. That's why this might look really high. However, they also diluted their shares. There might be a share split that happened. And if we see what's the shareholding pattern, the owners are diluting. They are not the majority stakeholders in the company. And this company is mostly going to follow the trajectory of Amazon. It might not become the next Amazon, but that's their business strategy and long-term business like path they are taking. The DIIs are building position in this. They increased their stakes from almost 15% till 23% in last 1 year, which is relatively interesting. It's not rare that DIIs come in and buy at such a high valuation. Now, the company raised capital in the past in last 1 year, and they are using that capital to, I think, go out and consolidate the market. If you look at the cash flow statement, the amount of investment purchase line item is just growing over past 2, 3, 4 years. And I think the main focus of this company right now is expansion through market consolidation. And they are doing that. Like recently, they acquired Blinkit, and majority of this cash flow might be going to that acquisition as well. Now, another major problem I see with Zomato is the free cash flow or profit from operations that they have right now. I know they are focusing on expanding their top line, but this number is just too low, and this leaves the company in a situation of vulnerability whenever things are not going right and the competition increases. However, one good thing is that the company does not have any significant amount of debt. That means they don't have any liabilities that they have to pay for expanding their business, because they are mostly going to come to the market and raise capital. But I don't like doing that as well. Like if a company is doing that too much, they might be addicted to it. So how should we value a company like Zomato? So from a market cap to sales point of view, this company right now is trading at a same market cap to sales as Trend trades, and that way you can put up a comparison. A new age tech startup versus a fast fashion company that's more operationally heavy. I think Zomato wins the race between these two. And I think from the growth point of view and current valuation point of view, I think this might be a company that we should keep in our watch list. So on the basis of given factors, I would like to give Zomato a buy. I don't think I would like to bulk buy in this particular stock because the company is trading at its all-time high valuation. I would like to just gain some positions over time and see if there is any market correction because of any news, and then probably I would bulk buy. But the company is clearly focusing on growth. It's not trading at a valuation higher compared to its peer when we look at metrics, not just P. So that's why I would like to give it a can buy, not a must buy or once in ages buy. The next company on our list is the second biggest private sector bank in India, and it's the main competitor for HDFC Bank. It's called ICICI Bank. It was involved in some of the frauds and news in the past when there was a CEO called Shilpa Kochar. However, the company is improving its operation and it's right now touching its all-time high. So let's try to value this company. Now, ICICI Bank is a 10.29 lakh crore company. It's trading at a PE of 20. The company maintains a healthy ROE of 18%, which is less than HDFC Bank, by the way. And the company right now is trading at a PEG ratio of 0.15. That means the company is able to deliver more growth than the valuation it's trading at. If we look at the sales growth, the company is growing its sales at about 17% in the past, which is higher than HDFC Bank, because you have to understand HDFC Bank also went through a merger. The company is growing its profit at a rate which is better than other banks in the market. They are able to grow their profit by almost 27% in last 3 years, and in last 1 year they are able to grow their profit by 15%. Now, in my opinion, ICICI Bank is relatively simple for me. If I have to compare between HDFC Bank and ICICI Bank, these are top two banks, and I would rather put my money in both of them than just putting my money in one of the place. So I would like to rank ICICI Bank as can buy since I'm not holding any position. But if you are an investor who already are holding ICICI Bank, maybe it's time just that you hold the position and not bulk buy in it right now. So next on our list is Trent. It's India's one of the biggest fast fashion company, and again, it's owned by Tata Group. I mean, talk about a good company in India, and it's find its route to Tata Group somehow. So let's talk about Trent. So the company was trading at a historical high valuation in the past, and right now it's observing a correction in last 3 to 5 months. So let's see what's the valuation of this company, and does it make sense for us to invest or hold this particular stock. Now, Trent is a 1.93 lakh crore company trading at a PE of 135, and they enjoy a healthy ROCE of 30%. To value a company like this, we cannot use just P. We have to look at market cap to sales because this company is focusing on its growth. So, how much are we paying for this growth? So, in the 5 year horizon, the company P ratio is still market cap to sales ratio is still premium. The company traded at a market cap to sales ratio of almost 6, which is half of the current value in April 2023. So, there is a chance that the market cap to sales ratio can correct even from this position. I'm not sure, but the company is able to grow at a healthy rate of almost 30 to 40% in past 3 to 5 years. Now, if we take a look at the shareholding pattern, both DII and the government are buying this stock, and FIIs are selling this stock. So, what are DIIs looking at when they're thinking about buying this? Now, if we take a look at the cash flow statement, the company is able to maintain a healthy profit from operation, and they are able to reinvest that cash flow in buying fixed asset, going around the country, buying out shops, malls, which will be finally renovated to West Sides or Zudio, and youngsters can come over there. And on the basis of the huge amount of population that we have, and that too a population demographic between an age of 25 to 40, and a lot of young Gen Zs as well, I think this company is bound to benefit because they have that click in the mind of the generation now. Now, since last 3 years, I have been thinking about building position and trend, but I was never able to do that because of the valuation, and the valuation was just too high for me to just make an entry. However, trend is still trading at a valuation where I would not recommend bulk buying. I think it's a valuation where I would like to build some position and see this position grow over time as the market mentality and sentiment change, and probably see if there's a good bulk buying opportunity. But this is a business model that I really like because I have seen on the ground the foot counts in these stores and the craze in the youngsters, because they are not looking for clothes that are really costly. They are looking for clothes that they can wear 2 months, 3 months, and then get over with. Now, next company on our list is really special. It might be the only company in the world that's operating in airline business and is profitable. It's called Interglobe Aviation, and you might know it by a name called Indigo. You must have heard this news recently that Indigo placed an order of 500 jets on Airbus, and they're looking for this capex to expand their business. And considering they are profitable now, this capex is just going to strengthen their balance sheet even further. So let's try to understand the valuation of Indigo, or so-called Interglobe Aviation, based on its fundamental and its growth prospects. Now, Interglobe Aviation is a 2.22 lakh crore company. They are trading at a PE of 30, which is premium to Nifty, and they have a healthy ROC of 19%. The debt to equity for this company is 7. Let's see what's happening over there. This is too high for me to invest in this particular company. If we take a look at the balance sheet, the company has a significant amount of cash reserve, almost 9,000 crore. The short term borrowings of the company are 1,800 crore, and they have lease liabilities. I think these lease liabilities are the amount they have to pay over time for leasing a particular jet for running their operation, as they might be lacking the carrier fleet or some other reason. Apart from that, we know this news that the company is looking for an expansion by 500 jet. That means that revenue is going to come into the profit and loss statement and the total sales and the top line of the company in the coming years. The company is able to grow its sales at a rate of almost 17% in last 1 year, and they are able to grow their sales by 46%. But this is because of the COVID rebound that happened. However, the profit growth does not look highly consistent. It can fluctuate. So let's see what happened with sales and margins over. The interesting part about a business model like Interglobe Aviation is it's really hard for them to maintain margins. And anything that happens around the world that disturbs aviation, or that disturbs the flight business, be it a war, be it a conflict in some part of the world, then this company is going to get impacted. Apart from that, the margins are thin and they are really risky as well. So, am I ready to give a valuation of 30 for a company like Interglobe Aviation trading at its all-time high with such a high debt to equity ratio, considering the debt is only because of the lease liability that the company has? I think the answer is yes, but it's not a must buy or a bulk investable company right now. Now, how would I analyze Interglobe Aviation? So, fundamentally, I would like to stay away from a business like Interglobe Aviation because it's airline business, and they are the only one that's profitable in this business, and no airline company is profitable in this business. So, the problem with a company like Interglobe Aviation is they have found something that is working and they might grow. Do I want to be part of that growth? The answer is no, because I think this company is really out of my scope of how to run and what's the way you need to grow a company like Interglobe Aviation. I'm sure they are planning to get 500 jets and they will get higher revenue in the future because the capacity is going to expand. But if they are really silly about managing their balance sheet and with a debt of almost 7, a lot of things can go wrong. So I would like to just, if I am riding this wave, I'll like to cut my positions, but I would not keep on investing in a business model like this. And that's all what I have for you for today's episode. I hope you enjoyed this video and were able to learn something. Do hit the like button and subscribe to Vishal Wealth View. Bye bye. Stay safe.